Let's take a look at the last 35 years. Since we looked at the market over that span, let's look at gold. Notice that if you bought gold in the early to mid 80s and held it through the year 2000, you're probably a very disappointed investor. All gold did was stay flat up until the mid 90s, averaged about $400 an ounce, and then went from 400 down to 250 in 2000. See, this was a terrible time to be acquiring gold if you wanted it to go higher in value. And if you think about money and the way it flows, it'll make sense. See, remember, our stock market was booming during this time. The market went up 10 times in the same period. So money flows where it can get its greatest return. Money flowed into the growth environment of the stock market, and not a lot of people were looking at gold. In fact, the idea of owning 5 or 10% of your total portfolio in gold was actually kind of created during this time. See, the advisors had remembered the late 70s where the markets collapsed and gold went from $40 to $800. And so you wanted to own gold as an insurance policy, have some of your portfolio in gold just in case that ever happened again. But as you can see, if you bought gold in the mid 80s and held it till the early 2000s, you did not do nearly as well as what you could have done. Okay, now let's take a look at gold from the year 2000 to today. See, what I'm talking about right now is the inverse relationship between gold and the markets over time. It's interesting. Our stock market's trading at all-time highs as I film this. Okay? The S&P 500 today, September 15th, hit 2,500 points for the first time ever. So if you just looked at that number, you'd say, wow, the stock market's booming. And yet, it's taken 18 years to double. In that same period of time, gold's gone from $250 an ounce to $1,325. This piece of property has increased in value more than 5 times. The stock market, where most people have their money, has roughly doubled in the same period of time.